Welcome to our deep dive on the Backdoor Roth IRA tax trap. Today, we'll explain why small pre-tax balances in your IRAs can cause oversized tax headaches when you execute a backdoor Roth conversion. Then, we'll walk through this simple fix that keeps your strategy clean and your taxes low. Along the way, we'll use diagrams, clear examples, and quick quizzes to lock in the concepts. Let's begin by outlining what we'll cover and how this all fits together. First, we'll define the backdoor Roth strategy. Next, we'll reveal the Pro Rata Rule and why even a tiny pre-tax balance, like $5, can complicate your conversion. Then, we'll show you the clean fix, why targeting a zero balance in your non-Roth IRAs by December 31st is critical. After that, we'll follow a simple timeline and cover Form 8606 filing. Finally, we'll reinforce your knowledge with short quizzes and key takeaways. Before we go further, a quick and important disclaimer. This video is for educational purposes only. It is not legal, tax, or investment advice. Your personal situation may differ, so please consult a qualified tax professional or financial advisor before acting on anything discussed here. With that said, let's move into the essentials of the backdoor Roth strategy. The backdoor Roth is a two-step maneuver designed for high earners who exceed the Roth IRA income limits. Step 1. Make a non-deductible contribution to a traditional IRA. Step 2. Convert those funds to a Roth IRA, typically right away. The goal is to move after-tax dollars into the Roth without triggering additional tax, provided you avoid the Pro Rata Rule trap. Let's visualize the flow next. Here's the simple flow. First, you contribute an after-tax amount, say $7,000, to a traditional IRA. Second, you document that contribution as basis on IRS Form 8606. Third, you convert the funds to a Roth IRA as soon as practical. Finally, make sure that across all your non-Roth IRAs, traditional, SEP, and simple, you have a zero balance by December 31st of the conversion year. If you do, your conversion should be tax-free to the extent of your basis, and your reporting stays straightforward. Otherwise, the Pro Rata Rule can create taxable income and complexity. Now the trap. The Pro Rata Rule. The IRS looks at all your non-Roth IRAs combined, traditional, SEP, and simple, as a single pool. The taxable portion of any conversion is calculated proportionally. Taxable amount equals the conversion multiplied by the ratio of pre-tax dollars to your total IRA balance at year-end. Because the snapshot is taken on December 31st, even a small pre-tax amount lingering in any of those IRAs, think $5, can force a slice of your new conversion to be taxable. This not only adds tax, but can complicate your Form 8606 reporting. Therefore, year-end balances are crucial. This pie chart shows the year-end composition of all your non-Roth IRAs combined. On one side, a very small pre-tax amount, $5. On the other, your large after-tax basis, $7,000. Despite the tiny pre-tax slice, the pro rata formula still allocates part of your conversion as taxable, because the IRS treats all IRA dollars as one pool. The key message is that even small pre-tax amounts matter if they exist on December 31st. Here's the clean fix. First, target a zero balance across all your non-Roth IRAs, traditional, SEP, and simple, by December 31st of the conversion year. Second, if you discover stray pre-tax dollars in any of these accounts, convert the entire balance to your Roth IRA immediately. You will owe income tax on that small pre-tax amount, but this is typically a minor cost that preserves the tax-free nature of your main backdoor conversion and simplifies future reporting. Third, continue making non-deductible contributions and convert promptly. Finally, always document your basis and conversions on Form 8606. This timeline lays out the rhythm of the process. Early in the year, make your non-deductible contribution and convert to Roth as soon as practical. During the year, avoid rolling pre-tax funds into your IRAs and keep those non-Roth IRA balances at zero. On December 31st, you verify that all non-Roth IRA accounts have a zero balance. During tax season, you accurately file Form 8606 to report your non-deductible basis and conversions. This cadence helps you avoid the pro rata trap and maintain clean records. Quiz time. The question asks, what happens if you convert $7,000 to a Roth IRA but have $5 of pre-tax funds across your IRAs on December 31st? Option A says nothing happens and no tax applies. Option B says part of the $7,000 becomes taxable due to the Pro Rata Rule. Option C says all $7,000 becomes taxable. Option D says only future conversions are affected. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that part of the $7,000 becomes taxable due to the Pro Rata Rule. The IRS aggregates all of your non-Roth IRAs and uses your December 31st balances to compute a proportional taxable share of the conversion. Even a small pre-tax amount creates a taxable slice. This table clarifies scope. Traditional, SEP, and simple IRAs are included in the pro rata aggregation, and their December 31st balances are used in the formula. Roth IRAs are excluded entirely. Inherited IRAs that you cannot treat as your own do not affect your personal pro rata math. Employer plans like 401(k)s are outside the IRA pro rata calculation. Understanding this scope helps you manage balances correctly. Let's compare two scenarios. On the left, you achieve a zero balance across your non-Roth IRAs by December 31st. In that case, your conversion is generally tax-free to the extent of your basis. Your Form 8606 reporting is straightforward, and your records remain clean for future years. On the right, if any pre-tax dollars remain at year-end, a portion of your conversion becomes taxable. This triggers more complex pro rata calculations and increases the risk of basis tracking errors. Form 8606 is essential. Use it to report non-deductible traditional IRA contributions your basis, and to report Roth conversions. If you skip Form 8606, you may lose track of your basis, causing you to pay taxes twice on the same dollars. Accurate filing protects your backdoor Roth strategy and keeps your records aligned from year to year. Always keep copies of prior 8606 forms for reference. Let's work a quick example. Suppose your year-end total across all non-Roth IRAs is $7,005. Of that, $5 is pre-tax and $7,000 is after-tax basis. The taxable portion of your $7,000 conversion equals $7,000 multiplied by 5 over $7,005, or about $5. While that may sound trivial, the presence of any pre-tax amount forces pro rata math and complicates your records. The better approach is to eliminate those pre-tax dollars before year-end, so the calculation remains clean. Here is your second quiz. The question asks, which deadline matters most for avoiding the Pro Rata Rule impact on this year's conversion? Option A says the day you convert. Option B says December 31st of the conversion year. Option C says April 15th of next year. Option D says any day before tax filing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is December 31st of the conversion year. The pro rata calculation uses a year-end snapshot of your combined non-Roth IRA balances. Keeping those balances at zero on that date is the key to a clean backdoor conversion. This pie compares outcomes conceptually. The clean backdoor scenario, where you maintain zero pre-tax balances by year-end, keeps nearly all of your conversion tax-free up to basis. The taxed slice represents the avoidable portion created by leaving pre-tax dollars in your IRAs at year-end. The visual reinforces why targeting a zero balance is so valuable. Here are the key reminders. Maintain zero balances in all non-Roth IRAs by December 31st. Convert any stray pre-tax dollars immediately, and accept the small tax as a trade-off for clean records. File Form 8606 whenever you contribute non-deductible dollars or perform a conversion. Keep careful documentation of contribution dates, conversion dates, and year-end balances. And when uncertain, consult a tax professional, because the details matter. Let's summarize. Contribute non-deductible funds, convert promptly, and remember that the Pro Rata Rule uses your December 31st balances. Keep all non-Roth IRAs at zero by year-end to maintain a clean strategy. If tiny pre-tax amounts exist, convert them and pay the small tax to avoid ongoing complexity. Finally, file and retain Form 8606 to protect your basis and keep your records accurate. Thanks for watching. If this helped you avoid a tax headache, Please like the video, share it with a friend who needs a clean backdoor Roth, and subscribe for more clear, practical money strategies. Post your questions and experiences in the comments. We read them all and may feature your scenarios in future videos.